just that mild bit of recovery taking place. So we're back, just bobbing in the green, back at 9,200. But again, it's a very, very feeble market right now. You don't know which way we're going to finally settle down if yesterday is any precedent to go by. The only good thing is that the breath has recovered and now it's the advances taking over. NIT Tech gets a thumbs up after its inline numbers, holding up 10.5% right now. There's Equitas holding up 5%. Mindtree is holding up 3%. Indiabulls Housing Futures up 3.7%. And Tata Chemicals as well, which is holding up about 4.5% as we speak. But let's welcome on board Rashesh Shah to chat about the markets, economy, what have you. Rashesh, hi, good morning. Good to have you on the show. Hope you're doing well, staying at home, staying safe.
Hi, Tina. Thank you for this. Hope all of you at ET now are also doing well, keeping safe and keeping all of us informed every day.
That we are right on top of working from home, but still doing that. But Rashesh, just a word on the market really. You really wonder in disbelief, the fall to 7,500, then that mammoth recovery all the way to 9,800, and then now again this fall coming in. Do you think there's exuberance playing out in the market, wherein you typically, as the case would be, they've overshot on the downside and on the upside for us?
Actually, very hard to read, markets on a short-term basis because one of the jobs of the market is to, on a minute-by-minute basis, really, project the entire long-term future and discount it as quickly as possible. In that quickness, you will have a lot of volatility. Obviously, what happened in March, I think, spooked everybody. All over the world, investors got very spooked, and it was an unknown. So the markets reacted and panicked as a result of that. I think April, there has been some sense of calmness because a lot of the governments and central banks have stepped up. There is a feeling that, governments and central banks will do whatever it takes to make sure this doesn't get completely out of hand. It's obviously going to entail a lot of economic pain. So I think first it was complete panic. Then there was some sense of relief that we have seen. Now there is a realism coming in that, see, the fact is most investors realize COVID is not going away until we get a vaccine or until we get herd immunity. COVID is going to be around and we are not going to stay completely locked in for a long time. So the current, I think, hesitation or tentative approach of the market is because market is trying to figure out how does this living with COVID affect the economy. We first said close down. And we all assume that once we close down, it should be okay. When we open up, COVID will be gone. But COVID is not gone. COVID is going to be there for the next few months. So we all, economy, business, individuals, have to learn to live with COVID. And learning to live with COVID is going to entail some economic cost. And the market is now trying to assess it company by company, industry by industry. So I think it was, and this always happens in the market. When markets are unprepared for an unknown, there is always panic, then there is a relief, and then after that there is realism.
Yeah, absolutely. But as an investor, Rashesh, what's the best strategy that you can adopt? I know, the lure of buying into that dip of 7,500 was there, but many thought that, you don't know, wait for the rock to settle down. It's fine if you buy 20% higher, but buy when you've got the definitive signs that this market recovery is here to stay. And even right now with this recovery all the way to 9,800 or, now 9,200, you're a little unsure about how long lasting this is going to be. For the retail participant out there, besides of course continuing with your SIPs, which are a long-term investment rationale, what is it that one should be doing in this market? Is this the time to buy, or do you think cash preservation is the only mantra for now?
Actually, I don't follow markets as closely, but from an economic perspective, as you very correctly said, I think things like SIPs and all are designed for this kind of environment, that you don't panic in this environment and either start investing or exiting the market only because of this event. So I think SIPs are very good. I think investors should continue. I think on a long-term basis, they even out the good news, the bad news, the good days, the bad days, all of that. I think on the whole, I think investors should be careful, not really chase the market as a whole. I think they should look at individual stocks. If the investors through your channel and others are able to study, understand good individual companies which look attractively priced, slowly they can buy a little bit in companies that they are comfortable with and they are sure they will hold it for the next 2 years, and they will also hold it if the stocks go down another 30-40% from where they are. You need that level of conviction to be able to buy at this time into the companies that you are buying in. Outside of that, I think we are all trying to figure out what is the impact of COVID on economy, companies. We have seen April was really bad. I think a lot of companies had zero revenues, like auto sales. There was zero auto sales in April. I'm fairly confident that I don't think we'll see an April kind of a month again. Obviously, May will be an improvement over April. We will not get back to normalcy, but at least what we saw in April should be as bad as it gets from an economic activity point of view. But I think the real impact on earnings and liquidity and long-term investments and economy will take another 4-5 months to pan out. So investors who want to study the environment, study the impact, really should be more patient. Investors who are very convinced about some companies and they know the long term of those companies and they're comfortable investing in them and stay for long term, there could be a chance to selectively buy those. But I think idea is to be calm and patient and not chase or panic.
How will the NBFC space change according to you, Rashesh? Not everybody will survive. The few will survive will gain disproportionate market share. NBFC stocks are being punished. Some deserve it, some don't deserve it. There are genuine concerns when you see a LTR or two failing, when you could ask yourself that, look, if banks will not lend to NBFCs, if a debacle like Franklin is going to happen, how will NBFCs survive?
So it's a very important question, and obviously lots of people are grappling with it, even in the government and Reserve Bank, in the industry, NBFC, because as you know, there were three effectively credit channels for the Indian economy. One was banks, one is NBFC, and one was the bond market. What happened 18 months ago, I think the NBFC channel got choked post ILFS and all the things that happened. I think you are all aware of that. As a result of that, the NBFC liquidity channel, credit flow channel got choked. Now the bond markets have got completely dislocated, and I think we'll have to come up with a new paradigm for the bond markets in the next few quarters. And until that happens, I think the bond markets also will be outside of that. Banks have had 5 years of high NPAs and they're very risk covers, and because of all the investigations and vigilance, in general, the NPAs that they're already carrying and what the pain they've gone through for the last 5 years have also made banks very cautious and extremely risk covers, and that's why we saw LTROs failing and all that. In fact, the irony is today banks have more than 8 lakh crores, more than $100 billion in reverse repo with RBI, which is earning 3.75 for them. And this is like really, I think, hurting banks also. But banks would rather keep money with Reserve Bank at 3.75 rather than take risk and lend into the economy. So the banks are choked from a credit flow. NBFCs are choked. Bond markets are choked. This really is a moment of credit getting choked for the economy, and we need to go back to the drawing board. I think NBFC's business model will have to re-evolve. I think the days where NBFCs used to be very balance sheet heavy, where they used to just borrow on their balance sheet and on lend, and really intermediate via balance sheet will come down. NBFCs will become more an origination engine and a collection engine, and they will become partners with bank, but they will become an extended arm of the banks. I think the new model for NBFCs is going to be they will not be as dependent on the commercial paper and the bond market for the next couple of years. I think the earnings and growth of NBFCs will be subdued, and NBFCs will have to reinvent themselves using technology, analytics, partnership with banks, because NBFCs have a lot of advantages. They have the origination cost is low, their collections are a lot more, a lot more proactive. So NBFCs know the needs of the customer. They can go after the niche markets opportunities out there, but they will not be able to take a lot of balance sheet and ALM risk. And that balance sheet and ALM risk will only be taken by the banks. Like what happened in Franklin Templeton is ultimately an ALM risk, right? Because investors want to redeem and the mutual fund is not able to have the liquidity for that. So I think NBFCs and mutual funds and bond market taking ALM risk will go away. Banks will be the only one because they have the backstop with RBI will take the ALM risk, and NBFCs will become partners where the ALM risk will stay with the bank. Maybe the credit risk can stay with the NBFCs. But we have to now start segregating the ALM risk and the credit risk in the environment.
Okay, fair point. Looking at the way how liquidity is there in the system, and we were discussing it in the morning, Reserve Bank of India on Monday itself mopped 8 lakh crore because of the surplus liquidity. Banks are in no mood to lend. When I speak to bank, they said, look, we need to be prudent about risk. We are in no mood to take risk. So NBFCs don't have the ability. Mutual funds do not want to lend. Banks have the liquidity, they do not want to lend. So it's like a wheel which is it is like a virtuous cycle which is starting. It's a dangerous cycle, isn't it? I mean, I'm sounding bearish, but I'm simply stating facts here, and those facts are telling you that we are in for a big crunch.
You are absolutely right. I think you have raised one of the most important points regarding even the opening up, because I think closing was easy in that sense, because closing was a single shot. You could do it by diktat, and you said, let's close the economy, everybody stay at home for next 3 weeks, 5 weeks, whatever. But opening up cannot happen by diktat. Opening up will happen only with confidence, with trust, with comfort. So even if a manufacturing company wants to open up, they will have to be sure that there is a demand out there. They will get the raw material, and the suppliers are also out there. The supply chain is working. The dealerships are open. So opening up is going to be a lot more calibrated, a lot more gradual, but is going to require a lot of confidence. And one way of injecting confidence in the economy is through liquidity and credit availability, because we're asking employers to pay salaries, we're asking people not to fire people. That is okay, but you need the cash for that. I think companies will forsake profits, but what do they do if they don't have the cash? If they are not getting cash inflow and their outflows are still there, cash is going to be a big requirement, and we need to find answers to that. As you said, all three channels, NBFCs, bond market, the bank market has choked off. We are seeing a small part, it won't be enough, is the fund market. The AIFs and all that are starting to happen. We ourselves in Edelweiss, we run quite a few AIFs and credit funds. We are seeing good opportunities on that, but they are very small part of the answer. I think eventually we have to answer this one question. RBI is the liquidity provider of the last resort. That is what central banks do. Central banks are the liquidity providers of the last resort. But who is the risk taker of the last resort? If the whole environment, all the participants, banks, mutual funds, NBFCs don't want to take risk, who will take the risk? Who will backstop the risk? If an MSME needs the money to pay the salaries of its employees and to pay its dues and all, and somebody needs to give them a loan, somebody has to take the risk. I think that should be the government. That should be maybe Reserve Bank of India. This is not new. This happened in the US after the 2008 financial crisis. And that is where the US Fed stepped in and said, we will buy bonds directly in the market. We'll buy credit card receivables. We'll buy auto loans. We'll buy student loans in the market. We'll invest in credit funds as an LP, as a limited partner. And we will give money to the credit funds to buy credit, in the market. The US government came out with TARP and actually started investing equity money. And also we need confidence capital. And the only people who can really inject that are the government, because government is a sovereign. They have ultimate backstop, and ultimately it's good for the government, because if companies go out of business, they don't pay their employees, they don't pay GST, they don't pay taxes, government will anyway lose out of this. So the question to ask is, government should act. They should act prudently. They have their own constraints, but they need to act, because they have both the options. So you will lose either via economic growth slowing down, tax collections coming down, defaults happening, or you will lose via taking some credit risk, where a few people may still go under even if you extend them credit. Some MSMEs will struggle, but it is better to do something than not do something.
All right. Final question, and I'm going to ask Rashesh Shah, the investor. If Rashesh Shah, the investor, who has a deep understanding of financial market, credit market, other markets also, understands the ARC business, AIF business, if you have to invest for next 3 years into a theme, a company, a business, apart from Edelweiss stock, because you will answer me Edelweiss stock, so I'm not giving you that scope. Apart from Edelweiss stock, if you have to invest in one business, company, sector or theme, where would you park disproportionate amount of money, given that right now bargains are available?
I think that a lot of things will play out. I think I would obviously invest in India as a whole. I think India will come out of this. I mean, there will be a vaccine, there will be some herd immunity at some point of time. And India's story is not over. It's going to be painful. Few quarters, maybe a couple of quarters will be very painful. But yeah, I think the India story is alive. And in a way, this is going to be a growth crisis for India, which will force us to reform. India in crisis have always reacted very well. And this is much closer to a 1991 balance of payment crisis we had. And we saw what happened to the Indian economy post 1991. I think this is going to be a growth crisis of a similar order. That time it was a balance of payment crisis. Now it's a growth crisis. And I do think that India will change, India will reform, and the much needed reforms will happen. So first, I think I would be bullish on India. I think some of the government-owned banks, PSU banks, will be big beneficiaries of that. Some of the good private banks will be good beneficiaries of this. Some of the healthcare companies will be very good beneficiaries. The pharma companies will be very good beneficiaries of that. And eventually, ultimately, if the valuation correction is high, some of the FMCG companies and all, because eventually consumption will come back. It might come back after a year. So I think obviously you have to be valuation sensitive also. But I don't think the India story is over. I think this, pharma, FMCG, good quality banks and all will ultimately come back because we are not going away. And even things like cement and all will do well because eventually cement is an ongoing business in India. It can't be substituted with imports. Construction will happen at some point of time. And, it's an evergreen business, but it is also at what price you're buying, which company you're buying is very important because you can't buy everybody in the industry. So I think company specific price specificness is important. But these are the themes I would not lose faith on. I think India will come back with a lot of pain that we will take in the next few quarters. But I think we are prepared for that. As I said, April was as bad as it got. And we should remember, we have survived April. If you can survive April where most companies had zero revenue, I think the recovery is going to be slower and painful, but I don't think we'll see a repeat of April again.
All right, Rashesh, I really appreciate your time. Thank you for joining us, and so glad you could join us with your open thought. I mean, for me, that last answer was a very interesting takeaway as to where Rashesh feels right now there is opportunity for investors and for long-term, for patient investors really to pick up some bargains. Let's take a break. Come back. It's been a good comeback for the Nifty. It's been a good comeback for the market. The market breadth is not classic in nature, but it's much better than what it appeared. It is much better than what it was at 9:15 or 9:20.